all bases of comparison that most people are talking about, 30s and as a fair level, and even 15s, they're only coming out the ground at 6.9 now, if it's silver ounces to gold ounces, which is already a single digit, so that's not extreme. That ties in with what, and you could overshoot to that. You could have three silver ounces by a zero gold ounce at some point. I'm not saying that as a prediction, but in an exceptional, for a day, a moment, in an overshoot, nobody said you'd get 128, virtually 129 ounces of silver needed to secure a single gold ounce, because the original movers were the central banks, and they were moving the needle on gold, but trying to keep a lid on silver because that's part of a suppression technique on a smaller market. So you have a complete perversion in one direction, and you will get an overreaction when it is unwound to the downside.
The gold-silver ratio is drawing renewed attention as market distortions unwind. Analyst Francis Hunt notes that current mining output sits near 6.9 silver ounces per gold ounce, already a single-digit ratio and far from historic extremes like 128:1. While not a formal prediction, Hunt suggests temporary overshoots could push ratios dramatically lower during volatility spikes. Central bank activity in gold markets combined with alleged silver price suppression may have created long-term imbalance. If that distortion reverses, silver could experience sharp upside momentum, potentially creating short-term scarcity and explosive repricing in precious metals markets. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The incredible thing is my life feels synchronized with the whole Ponzi-onomics and the sound money theme. And, our very first videos were talking and covering gold in 2009 when Bullion Vault was launched. They were actually just a bit before that. I monologued and read out their core report for the case of sound money. I remember him saying 3,000 and minimum, then 5,000 and beyond, and you had all these assumptions and everything, Paul Tustain, and I was reading it out and all of that. And back then, we traded as low as 1,060 odd just before 2016 lows, which was the Shanghai Accord. And now all those numbers that he's spoken about are already well done, and we haven't really begun all the major resetting that we truly need to do. The gold-silver ratio, generally, we feel you will get an overshoot. Don't forget, you went as high as on this moment here, which was during the 2019 event. You went as high, according to OANDA, 128.692. Just think of those 25. So let's go with 25 coins a tube. You're talking 4 tubes plus another tube, and then still another 3 individual silver ounces just to get that one tiny gold ounce. That has been it. And they get pulled out the ground at single digit numbers. Whatever overshoots to the upside has a habit of chronic overshooting to the downside, and all bases of comparison that most people are talking about, 30s and as a fair level, and even 15s, they're only coming out the ground at 6.9 now, if it's silver ounces to gold ounces, which is already a single digit, so that's not extreme. That ties in with what, and you could overshoot to that. You could have three silver ounces by a zero gold ounce at some point. I'm not saying that as a prediction, but in an exceptional, for a day, a moment, in an overshoot, nobody said you'd get 128, virtually 129 ounces of silver needed to secure a single gold ounce, because the original movers were the central banks, and they were moving the needle on gold, but trying to keep a lid on silver because that's part of a suppression technique on a smaller market. So you have a complete perversion in one direction, and you will get an overreaction when it is unwound to the downside, and you will have unobtainium. And we've already had patches of that. And a lot of people are pointing to the COMEX delivery and saying there's a lot marked for open interest delivery for which the stocks aren't already there. So you could have a contagion event sooner than you think when you ask, when will we have a kind of a Lehman-y moment where the things that's going bad suddenly have a whoa, and it gets into Main Street and everybody realizes and starts making the front pages? Well, that might be coming shortly, in February into March. It could be, but it might not. I can't tell you when news media will start to run what they should be running. But the scam is big. The scam is debasement. It is the debasement of both fiat and debt. And there's very few places that does the real job of capital preservation. And it's not the time to be 5%. Do you insure 5% of your car? Do you insure 5% of your house? Well, it doesn't mean you should insure 100%, but in some ways, I've kind of insured 200, 250% by activities, but I still don't have 100% only assets in gold if I talk about what I physically own. But I've used other instruments to be overweight, over benefiting, and then it's made us and our community members extensively wealthier. You're in the early doors stage. So to many people, this has gone on too far. Everybody frames things by their own personal frame of reference. This is the bull market to end all bull markets that ends, in essence, a fiat and debt debasement that has been going on since the establishment of the Federal Reserve, the original gold heist that saw the confiscation and then the revaluation up, the Vietnam War that led into the debasement of, they dropped more munitions than they did in the World War II, the Americans. And so the French started calling for the gold. That saw the window be closed. They were cheating. They were fraudulent. So you really want to believe known cheats and frauds, that everything in Fort Knox is in there. You're starting to hear some rumors and funny stories. I can't verify them, whether they're true or not. But if you're asking me, are they cheats and frauds? I would say yes. So do I have the confidence that everything is exactly as it should be in terms of Fort Knox? When they lie on the non-farm numbers, they do umpteen revisions, monthly, quarterly, everything. It's all about the initial number that everybody reacts to, and everybody forgets to react to the big revision back down later, because new number, all of those things. They're lying on the CPI. The dollar lost. I mean, why do we say we're lying on the CPI? Apart from shadow stats, which quite clearly runs the Ronald Reagan era numbers of 1983, I think it is. You look at the fact that the dollar lost 12.5% to the euro. This is a leper colony. Currencies are a leper colony, but some lepers are even more flaky than other lepers.
Precious metals investors are revisiting the historic gold-silver ratio extremes as market volatility intensifies. During 2020, prices on OANDA briefly reflected a ratio near 128:1, an unprecedented divergence many analysts viewed as distortion. Commentators such as Francis Hunt argue that mining output near 6.91 suggests structural imbalance, with potential for dramatic overshoots in the opposite direction. Growing scrutiny of COMEX inventories fuels debate over physical supply versus paper claims. As fiat debasement concerns persist, investors increasingly view gold and silver as strategic capital preservation assets. Let's get back to the interview.
If we talk about the silver market, and I mentioned that we were fortunate enough to get out, many people might be in disbelief. Go and have a look at our X there. That is the value of real technical analysis on a volatility-based function. But we knew after the run of the $90, and I believe I would have shown you this long-term silver chart possibly the first time I showed up with you, Stick. But I want to show it to you again if I didn't, to remind people. I've just got to do a small adjustment over here. 49.81428 and take that out as an imperfection. So this is our targets to remind everybody. So how far are we to where we expect to go? So first of all, dollar targets, we've said 333, then you'll have another rest. 333, you'll have another rest. And then eventually you will go single digit gold silver ratio. Many people are shocked at that. They say, well, for the last, it was normally 30 or whatever the case may be. You've forgotten the whole cycle goes right back to, beyond 1913. Everything you're comparing is part of the perversion where there was substitution against precious metals and the financialization of everything that led to the everything bubble. And right now, that bubble is already bursting. Everybody goes, when reset, Francis, as if it's like one day, one time, one moment. It's a process, and that process has already begun. We've shown the NASDAQ divided by gold ounces, massive head and shoulders. The stock market is re-rating against the gold ounces. Everything is re-rating against gold ounce. But just to finish with the silver, as I brought you here, this was the run of the 90.5. We said, okay, you're going to have an overshoot and you're going to have a pullback here. So we became slightly less aggressive on the leverage trading. We were looking for reasons to get square on leverage. All our profits we take out, which are what we call in our red pot which is the top of the pyramid, the middle slice, the orange pot, which is light leverage, and then tax it down to the blue pot so it becomes in new investment proceeds. We've been buying during the lows, I say lows, it traded to 64. The cheapest I was able to buy 7-digit sums of silver for was 94.8. That was when it was around 77. So the difference, and there's very many places that simply couldn't fill big orders and weren't interested, by the way. So this whole notion of, oh, there's no bullion dealer that wants to buy my stuff back. My local here in South Africa said his buybacks, which he used to do a lot of, and take that stock back in, have gone down 80%, and he's sold out all his next delivery before it's even arrived. So forget those social media posting that are trying to give you the notion that there's no demand for it in the dealer network for selling back your silver. So this goes to 333. This is log scale, by the way. Just in case people think that's not a brave shout, that's the distance in normal arithmetic geometric scale. So that's how much more you've got to have to go. And once you've run and reacted to the second interim, which is here, the open territory in between the core target, the second interim and the full target, typically is covered. It's open territory, the horse running across the field, galloping across the field. It's when it comes to the fences that it has to run and jump and then has fatigue and exhaustion and relaxes for a bit because that was tense. So it's like a fence. Think of it as fencing level. So this is a real massive part. The main part of the move is still to be coming on this. And then we go 4 digits on the single digit gold silver ratio call.
Silver market volatility is accelerating as bold long-term targets re-emerge. Analysts highlight technical breakouts and volatility-based strategies that previously anticipated major swings. Market commentators such as Francis Hunt project ambitious upside levels, citing structural fiat debasement and ratio compression versus gold. Meanwhile, broader asset revaluation is visible in the Nasdaq Composite when priced in gold ounces, signaling capital rotation. Since the creation of the Federal Reserve in 1913, monetary expansion has reshaped asset cycles. With debt markets under pressure post-COVID-19 pandemic, investors increasingly prioritize precious metals for capital preservation. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.